Jobs numbers coming in weaker than expected for April, missing expectations by 65,000. The economy adding 175,000 new jobs last month, while unemployment rose to 3.9%. Does this make the Fed's job a little easier? My next guest is predicting at most one rate cut coming from the Fed this year before the year's over. Joining me now is Andy Capron, a partner at Corient, an independent wealth advisory firm managing nearly $150 billion. A lot of growth over the years since I've been talking to you guys at Region Atlantic. So the mantra on Wall Street has been higher for longer. You've tweaked that a little bit, and you're saying later and less. What's the distinction?
Yeah. So here's the distinction. The first one is, I think when we entered this year, there was the expectation of a lot of Fed cuts, and also for them to be front-loaded or perhaps to start much sooner in the year. Even with
6 to 3 to 1.
Yeah, to now potentially none. Yep. My prediction is later in the sense that it's likely to happen all the way towards the end of the year. I think December is frankly the most likely, because at some point as we start the summer, it gets too political for the Fed to do an about-face on monetary policy in the face of an election. So I feel like December is the most likely time frame. But my most important point is less. I think many investors are used to low interest rates, have not adjusted their idea of a terminal or normal Fed funds rate up from something like 0%. They might be anchoring to something like 2%. In my opinion, we're seeing a really tight economy that is naturally undersupplied, with labor in particular. And I think it's possible that the terminal rate for Fed funds is something closer to 3.5%, maybe even 4%.
Which is kind of how it was decades ago.
Exactly.
Before the era of free money. So let's talk about tech investing. I'm sure your clients are clamoring for it. Hey, Andy, get me into this AI stuff. What do you tell them?
So what I tell them is, if you're a typical American investor, you already have AI in spades. If you're invested in the S&P 500, any large cap active management, you'll likely have the leaders in AI already present in your portfolio: NVIDIA, Microsoft, Google, among many others. They represent high double digits in a typical portfolio. So what I tell them is, you already have it. I don't think it's a bubble. And what I don't think you ought to do is look farther afield from the leaders. Here's why. One is, I view artificial intelligence as a super capital intensive endeavor. So the companies with the most free cash flow to throw at this and be able to take a few years to realize the profits of it are already those biggest ones that I mentioned.
Yeah, Amazon's adding more to its Anthropic investment.
Exactly.
And not everyone has $2.5 billion sitting around.
Yeah. And the other point I would make, and it's actually been to the benefit, I think, of U.S. investors, that the IPO market has been closed through all this AI frenzy. Why? Because usually the IPO market, in my view, sometimes incorporates a lot of speculative businesses that have a very long time to maturity. In this very high upfront cost market, I think it would be very hard for startups to really get their foot in the door and become dominant. So I think it's actually been to the benefit of investors that the IPO market's been closed. And my partial worry over the coming months is, because of a bull market, because of us hitting highs with relatively low volatility, that starts to change and investors start to get exposed to some of those more speculative frenzies.
Bad news for the investment banks, but good news for your clients.
That's right.
Let's also talk about foreign investments. So we've always been saying, hey, you got to diversify overseas. Back in the aughts, it saved your portfolio. But recently, it looks like the S&P is actually where you want to be. Well, what's your take on that?
So a couple of really interesting points to make there. First of all, last year, 2023, I think a lot of people saw a really dominant U.S. stock market that outperformed other global averages, which is true, but here's a little rub. The average American stock did worse than the average developed ex-U.S. stock.
Wow.
And it was all about the AI, it was all about the Mag 7 in the U.S. driving a higher index average. So ex-U.S. stocks are doing well. It's just getting lost in the shuffle. The other point I would make is, I think a lot of investors are used to thinking about international developed markets as banks, insurance companies, oil producers, low profit margin, commoditized businesses. I don't think that's the case anymore. Largest business in Western Europe is a company that makes weight loss drugs. Some of the largest producers of components for the AI revolution, the semiconductor manufacturers, are based abroad in Taiwan, Japan, and the Netherlands. And something that Europe has in particular that the U.S. does not, dominant consumer luxury brands. So
They do luxury well in Europe.
Like nobody else.
Unfortunately, we got to go, but real quick, indexing or active management for foreign stocks?
So I think when you invest in foreign stocks, indexing is probably the better way to go because you're capturing all this market dynamism and you don't have to worry about the selectivity. I think the diversification is worthwhile.
Andy Kaplan, thanks for your insights. Appreciate it. Barron's polled the biggest money managers on how to invest in this uncertain market, and their answers.